So imagine a global food company, Damian, milk cartons on breakfast tables worldwide, sponsorships in Formula One and top flight football. Billions reported in cash reserves. And yet, when the truth emerged, much of that cash simply didn't exist. Yet today we're going to tell the story of Parmalat and how that became one of the largest corporate frauds in history. And you and I will remember this because I think this was 2003. So this was back at the ING days.
Yeah. And, I think I just left by then, but it was definitely, I mean, yeah, it's definitely on my radar, not because I ever traded it, but there was definitely other desks making and losing a lot of money in Parmalat. It was a big story, definitely a big story.
Well, it was a big story. It collapsed in 2003, but I think, as you pointed out, because you went on to have this kind of further career in a trading house that focused much more on credit, Seaport. You know, people were trading the claims in Parmalat for many, many years, and ultimately it didn't
I remember
get cleaned up, I think, till 2011.
Yeah, I'm pretty sure it was on the price runs that the desk would send out, and we chat about. I mean, I was on the equity side there, but it was definitely a distressed debt led house, and it was always, you know, we got an axe in this. If you can find someone, they'll take the other side. So it was definitely, you know, still kicking around as obviously a distressed trade by then, but it was the trade that kept giving for some.
It's a great story, and it's one that actually, when we kind of, you know, I had it in the back of my mind, and then we've gone away and done the work on it. And actually, the resonance, what's so good about these war stories, as you call them, you know, they have such great lessons embedded in them that stand the test of time. And I have to say, for litigators, for auditors, for compliance teams, for investigators listening into this isn't just a piece of history. This is a case study on how financial reality can be distorted and how long distortion can survive. So anyway, we should go back and really see, you know, what the start of Parmalat was. You know, Damien, you know, I always love a timeline. Well, Parmalat really began in 1960s Italy, and that's when Callisto Tanzi succeeded his father as the manager of what was really a family grocery business. You know, they were into, you know, kind of seasoned Parma ham, a bit of tomato puree, and in fact, you know, Parmalat, the name fuses Parma and latte, milk. That's probably a terrible Italian pronunciation. Where's Riccardo Gastuda when you need him? But maybe Riccardo will come back on a later follow-up if we do a follow-up on this. Because, of course, he had an experience in Morgan Stanley trading distressed. So I'm sure he'll be all over the Parmalat story. But anyway, Callisto was born in Collecchio, an outlying district of Parma, in November 1938, so make him as old as my parents. And his education led him into accountancy, which is kind of interesting given how this story kind of unwinds and unravels towards the end.
No spoilers alert yet, Nick, come on.
Yeah, I don't want to be a spoiler, but I mean, you know, it is great that he had this career as an accountant. And I have to say, my dad is an accountant, and he's always, you know, you need a profession, you know, accountancy's a good profession. Well, I'm not sure it served Callisto Tanzi that well. Anyway, milk was an addition to the company in 1961. You know, he brought that in, and you know, Parmalat was this company that just grew, and it really grew on an innovation, not one of theirs, but the arrival of Tetra Pak. And they were a very early adopter of Tetra Pak. And this allowed them to, you know, really focus on long life milk, focused on really the distribution of this stuff. And, you know, reading around this story, very much it was up until then, it was all very friendly. You know, they kind of had these stores. People came to them, they had a chat and so on in his father's time. And it sort of really supercharged distribution. It changed the face of what they were doing, but it was a real business solving real problems, and it worked. He really became the pioneer in Italy of Tetra Pak. This totally accelerated their growth. They then, you know, followed that up with global expansion, and that diversified them into juices and further into packaged groups. And slowly this little dairy firm became a multinational group. And by 1990, obviously, think about the 1990 World Cup and, Nessun Dorma. I mean, this is the height of Italy football.
Italy, the brand.
Parmalat floated on the Italian stock exchange. And by 2003, Parmalat had more than 5,000 employees in Italy and more than 30,000 in the rest of the world. Latin America, and in particular Brazil, had become an important part of the Parmalat empire. And, to use a football analogy, where did it all go wrong, Georgie Best?
Pretty good.
But, and it was very involved in football. This company didn't just sell milk. I think another thing that old Callisto realized was a lot of the success would be on brand and image, and he really turned Parmalat into this brand. They sponsored the football club Parma AC. I think ultimately he may have even ended up buying Parma and getting it from like non-league into Serie A.
Mm-hmm.
So it's a bit like Skadi buying Bromley Town and seeing where we could take that to. I think we're a bit far away from that, actually. They're very, very successful. So shout out to anyone who follows Bromley Town. But he also sponsored the Formula One team of Brabham. And, for people, our age, we were sort of, school and college, the Parmalat logo was pretty prominent, actually. It was in quite a few places. And when you've got that sponsorship, when you've got that image, then people are going to draw the conclusion that you have, a big, stable company, and you can help build investor trust. And I guess, think about it recently, Damian, I say recently, last sort of 5 years, there's been a lot of crypto firms that have kind of moved into football which I think, again, heightens the branding.
Yeah, it's a sort of that way to, in inverted commas, legitimize your company. Maybe if you kind of go, well, if we can afford to splash out on flashy advertising and hoarding and sponsoring a team, then obviously we are the real deal. We're legit. We've got lots in the bank, etc., etc.
It does. It cements a perception. It's a means to an end, most certainly. So they got listed 1990. And then things really started to change, because if you looked at this firm in the 1990s, and by now it's listed, the group looked less like a dairy business and more like a financing machine. They had continued expansion that required debt financing. When you do raise debt, if you don't clear it, you've got to refinance it. And if you're going to refinance debt, you need people to have confidence in your company. Hence, again, this outside image projecting, we are great, we are strong, etc. The structure itself became highly leveraged. There was international fragmentation. They had these, entities all around, which they were then using, to raise money as well. So the Brazilian entity, for example, and we'll talk about this later, did a large convertible bond financing. I read somewhere that they had, it was a fraud, Parmalat, but they had a Cuban, or allegedly had a Cuban entity that produced, I think, enough for 250 liters of milk per person per capita in Cuba.
Oh, okay.
Although I think actually when it was kind of finally probed, they didn't actually even own it. They just basically put their name on this thing that was a Cuban company, which is kind of interesting.
Cuban, yeah.
That kind of made me scratch my head, actually, that why you'd go to those links, Damien, because I remember you and I, we were trading, I think it was Equant, which was it was like the air passenger check-in system that all the airlines owned. I don't know if you remember, but they came to, they approached us on the desk at ING to Cubana Airlines had a stake in Equant, which they wanted to sell. And that was the first time I ever kind of came up against sanctions, because we couldn't touch that piece with a barge pole, but we nearly did, because our ADR trader, who was of Cuban origin in the States, was like really, really hot to try and bid for this block of ADRs and nearly put the whole of ING out of business. Can you imagine? But there you go. So yeah, so their business was, as I say, highly leveraged, internationally fragmented, spread across all these offshore entities. Now, none of that's illegal, right? That's standard,
No,
but
quite.
that complexity can become camouflage. And so, again, it's this drift into where did it go wrong? Because there was a point at which we think they were legitimate in what they were doing, and then gradually there's a line crossed. And what started to happen with the complexity of their network, and obviously we know that his training was in accountancy, Callisto's training, started to be masked, debt started to be shifted around, and intercompany flows multiplied. They had this narrative that we've got a very strong cash position, but auditors, investigators looking at this is the lesson when you're looking at this stuff, or asking, are people asking the right question? Look at the picture. This company allegedly with strong cash and sponsoring all these great sports was constantly borrowing, and so that kind of mismatch is a bit of a classic red flag, right?
Yeah, absolutely.
So listing in 1990, and then they ultimately collapsed in 2003. It wasn't, well, yes, it was a sudden collapse, I suppose, and we're really going to get into that part of the story, which is a great part of the story, the collapse. But really, things built up a little bit earlier. By the late 90s, analysts were starting to get uneasy. They weren't uneasy about the business itself. Everyone was good about the amount of milk that was being sold. Maybe not in Cuba, but really uneasy about the financing story, because
sorry, and as you say, and I suppose as you alluded to at the beginning, if we certainly we both really started our career back in the 90s, mid to late 90s, and it was not necessarily Italy that had issues, but the rest of the world did. Well, certainly the emerging markets did. That was really, as you say, where things start to wobble, because you run into a series of crises out there, don't you? I mean, my teeth were cut just as the Asian financial crisis hit in '97, but there was one before that as well, wasn't there? There was.
You're absolutely right. I think what you and I woke up to, and all of these crises each time, they teach you something, don't they? They arm you, they tool you up. And I think what the the tequila crisis as called. So you had at the end of 1994, and I'd started in August 94, so it was like my first experience of a crisis. And I wasn't trading at the start of my career, but I was soon after. So I wasn't let's say I wasn't so aware, but I was still shocked by it. But effectively what happened was 20th of December 94, the government of Mexico devalued the peso by 15%. And that caused a real shock. And I remember, at the time I was working on the Barings Emerging Market Index, and we'd seen this really great performance in emerging markets. That was the Barings story. So this is ahead of Leeson in February 95. This is, if you like, the height of Barings before the collapse. It's funny how all these stories are intertwined. But that caused a broad shock across Latin America. And the reason was debt, because these companies had been tapping international debt markets, taking on a lot of US dollar denominated debt, which of course they're paying back in local currency,
right. It's the classic,
and profits. And if you suddenly find that your debt is 15% more expensive or harder to refinance, that's a big problem.
Yeah.
And Parmalat, with their business and their reliance on Latin America, and they moved into juices for production. Of course, there's a lot of mangoes down in Brazil, and oranges, and rest of Latin America, but sugar as well, right? Which you're adding into your products. This was a problem for them. Companies across Latin America had financed through US dollar denominated debt. And then, as you said, two further crises. 1997, where you and I really started working together. We're on the funds desk, which again was a similar, currency
Yeah, well, it was all, yeah,
situation in.
it's all driven by it's hot money flowing there. You then have currency devaluations, and then people running for the exit, and you have exchange rates ballooning. And if you're as you say, you've got US dollar debt. You're selling pints of milk, whatever it may be, in Brazil, in Asia, wherever it may be, and you're taking in local currency. So yes, you will be FX hedging as you go. But if you've had a dislocation in your FX, you're not going to be covered for that. So you've got a lot more debt, and you've got less dollar equivalents coming in to pay that off. So yeah, I mean it's a classic that's been seen again and again, and bizarrely we haven't really seen much of in recent years, which is always concerning. But we'll see how that.
Well, yeah, you say. I mean, that's right, Damien. I suppose it is. You should be on your guard. But I think probably there were big lessons learned at the end of the 1990s. So there was that kind of that financing lesson, and I was on the derivatives desk at this point, and in that ING Baring Financial Products business, the shock as these Asian countries jacked up interest rates to defend their currencies, and they really jacked them up. That was the funding lesson that we got as traders, because we just hadn't really thought about term funding at that point. And I think these are the kind of things like term funding and funding of positions. People are possibly slipping back or at risk of slipping back into those habits where they don't really think too hard about the positions that they run, especially when you think after 2008 and there was a kind of winding up of proprietary position taking, then people aren't thinking in terms of longer term positions anymore, and their perception, their awareness of how risky, the risk that is inherent in holding positions, not just in terms of market risk, but FX risk, funding risk. These are the things that people will lose, these skill sets that people could lose in these kind of situations. Anyhow, and then the other one, of course, was the 98 Russian crisis, just to finish off all the different crises that we had. And then you can throw in a bit of long-term capital management as well. So that, the end of the 90s was a pretty tough period in the markets. And say that you and I cut our teeth on that, coupled with a dot-com boom and money racing in sort of the 2000s, 2001 towards the internet stocks, a bit like racing towards AI now. So if you're a traditional business at the end of the last millennium, not very sexy probably to go out and raise money. Anyway, there was this growing skepticism around the business. People were very, very much actually alive to the fact that there was all this offshore subsidiaries. They found the group structures quite opaque. They found the accounts relatively hard to reconcile, and all the time, Parmalat were a serial offender. They kept coming back to the capital markets, and this made investors, cautious against the company. You had financial journalists asking more, probing them, more probing questions. There was nothing explosive, just unease. But this then grew into some regulatory curiosity towards 2002. And the Italian regulator Consob started requesting for clarifications to their accounts. These weren't accusations, let's say, just real transparency. And, the discomfort was forming. And really, the Parmalat story hinged on one bank account. That's what's so great about this story.
Yeah, you were telling me this earlier. Yeah,
Dave, I love a sort of story like this, and it is so good. So they had a Cayman-based subsidiary, Bondlat. Good milk. There you go. That's a bit of Esperanto for you there, DT. Which reportedly had a large cash balance held at the Bank of America, and this balance started to appear in the accounts in the consolidated reporting by 2002. So it kind of just popped up, and this was, a significant balance. I think we're talking approaching 4 billion euros. So, I mean, just to pop up like that was pretty punchy. But the fact that it actually got into the consolidated reporting meant that it got past the auditors.
Yes, yeah, you have to be
So
audited.
it was relied upon. It helped to sustain this kind of, we're cash rich narrative that the company had. And it was only later that people actually went and checked properly about whether this balance exists, and how that was discovered is such a great story. But when they did discover this, the whole thing unraveled. But I think, in fairness to the auditors, who were Grant Thornton, and this is the Italian auditors, they did query this balance, and this is why it's such a great story and why I love it. And I think it's food for thought for us in 2026, with AI and all of the challenges that brings over the provenance of material and information. But Grant Thornton wrote a letter addressed to the Bank of America asking for confirmation about the account. And this is the audit hourly. You've done all the work. You've kind of worked out that this looks a bit like we need to check it. Rather than sending it themselves to the Bank of America, they gave it to someone at Parmalat to post, and so the letter was never sent. I'm laughing, but I just can't. It's just such a great story, this, and I think from here on, people listening to the podcast will be reminded of Nick Leeson's moment of fraud, where there really was that moment of fraud, right, with kind of sellotape and scissors.
Sellotape and glue and scissors and a Stanley knife or whatever.
Well, this is no different. This is no different, DT, because Callisto got hold of Gianfranco Bocci, who was Parmalat's head accountant, and said, come up with a reply confirming the account's existent. We've got hold of this letter that the auditors have. So Gianfranco gets to work, and he has a scanner, and he makes an imitation confirmation letter, if you like, on Bank of America notepaper, where he'd sort of cut and pasted company stamps and signatures onto it. Why he needed to do that anyway, because him and Callisto were signatories anyway, but apparently this is what happened. And then brilliant move, he then put it through the Xerox machine and faxed the resulting sort of, hodgepodge confirmation several times to make it look authentic. And that, it didn't quite have the Nick Leeson, from Nick and Lisa at the top of the fax, which was in the case of the Bearings one, which I think is such a wonderful moment. But this was, made to look authentic. When it was presented to staff at the Italian office of Grant Thornton, they went, bene, or whatever they would say. But as they just accepted the account balance without any further question. And ultimately, Gianfranco and these two Grant Thornton staffers ended up in jail. So that's the cautionary, is, if you're going to accept the information without properly checking it, you could end up in jail. So after this is why the balance then ultimately got checked, is that by December 2003, Parmalat needed 150 million euros to redeem a bond issue. So, you've got to bear in mind that previously, in the previous year, 2002, they'd issued a convertible bond out of the Brazilian subsidiary to the tune of 500 million euros. So it's kind of like, wow, you need another.
You burned through that already, haven't you?
What have you been doing? Formula One, football, whatever. And the interest rate on that convertible bond, by the way, it's good to focus on this convertible bond, because convertible bonds tell you so much. Convertible bonds are supposed to be cheaper financing, right? Because that conversion property has value. Well, the interest rate on the convertible bond, Damian, was 10.5%. Right?
Yeah, I mean, that's. I'm not a converts guy. Obviously, that's much your background. But I was reading a story, literally, I think it was yesterday. In Japan, they're issuing a lot of converts now because rates, I know they're still low, but they have been basically zero for so long. Now that rates are up at sort of 2-3% in Japan, they're starting to look at converts because they are a cheaper way to finance, as you say, because they have, well, you're better to explain it than me, but obviously you can charge a lower rate because there's a kicker within the structure.
Yeah, that option to convert has value to convert holders, particularly those that arbitrage and short sell the stock, etc. Excuse me, against the conversion property. Also, this is a bit of a red flag because having, gone through the kind of the India mini crisis of 2006, India was a convertible bond market where you had a lot of premium redemption structures. So that what happened in India is that companies, for tax reasons, didn't want to pay coupons, didn't want to pay those ongoing interest payments. And because of the growth rates in India and the kind of the equity market performance, people got comfort that if if a company issued a bond at 100 and it matured at, say, 153 in 5 years' time, that's okay, because the stock price performance would be so high over that, it'll get converted. And the companies just didn't have to pay the interest. So they were like, wow, this is fantastic. We're just issuing bonds without having to pay any interest at all. And investors are going, well, I don't really mind that the stock price performance is so big. I'm okay. And of course, when markets didn't perform in 2006 and suddenly these companies started to have to find the money to refinance these and pay them on maturity, a lot of these companies really ran into trouble. And it's the same thing with this Parmalat convertible. It was a premium redemption structure, as I can sort of see. I mean, the details on this thing from, we're going back 23 years, but effectively from what I can see is that they issued a 500 million convert, but actually it was held in the accounts at something like 780 million. So there was this kind of ultimate, liability to the company, which makes me think it was a premium redemption structure. But anyway, with them needing 150 million euros, they sort of went back to their banks. Yeah. And one of their banks went, you
just raised a load.
Plus you've got why don't you just go down to Bank of America and go to the ATM and pull out 150 million? Why don't you just ask them? In fact, don't worry, we'll check it for you. And they send out a confirmation request to the Bank of America saying, hey, we'd just like to, how much would it be just to have 150 million of our full billion back?
Yeah.
And the response from Bank of America is like, what are you talking about? We have no record of this account. And at that point, when it was realized that the account did not exist, then, of course, within weeks, liquidity evaporated, insolvency followed, the investigation began, and Europe had its Enron moment. That was what Parmalat was for Europe. It was the Enron moment. And anyone who doesn't know about Enron, well, go back to episode 16 of the Skadi podcast, one of the early day episodes, and you've got a full recap there. But so there were consequences to all of this, Damian. Tanzi, he was prosecuted and imprisoned. Apparently, shortly after being imprisoned, just spent a lot of time crying and praying on his knees in prison. That's why I read the stories of the time, like the Independent newspaper and the Guardian. Everyone was reporting on this. I mean, it was a shocking situation. The CFO was Fausto Tona was the one that cooperated with the prosecutors, but it meant that other executives faced criminal convictions. There were director bans. There were civil claims. I did read about one guy who actually committed suicide, but again wasn't found to have been involved. But it's sort of, again, interesting, sort of Italy and suicide and so on, kind of raises a question. But I think that excuse me. The lesson from all of that, was that, there was real accountability for the directors after this. They did jail time, which is, really. Which
we didn't see much after 2008 crisis, for instance. We saw very little of. So, yeah, interesting.
And controversial, DC. Haven't seen much of it in the Epstein situation as well. So there we go. Anyway, going more to your side of stuff, Damian, and thinking about this actually, because you probably were trading quite a bit of this stock, given the amount of bonds and convertibles in the capital structure, but shareholders were largely wiped out in this one.
Yeah, I mean, annoyingly, where's a Bloomberg when you need one? Unfortunately, we don't quite stretch to Bloomberg here. I can't look up where the shares ended up, but. I think that they traded as worthless. I remember. I was trading it as in we were an agency desk. People would throw orders at us, and this stock towards the end was winging around 10, 15, 20% in a day. I mean, it was properly volatile, and volatility attracts certain types of traders. And if there's converts out there, people will be hedging, etc. But it was a pretty hairy stock.
It's funny as well because. You think back then, that was the real kind of infancy for Europe for kind of direct market access, and you're putting into, these orders going direct to exchanges. And I remember on this one, it was a fast market. You'd put orders in and you didn't even know if you'd been filled or not. I mean, it's terrifying stuff.
Yeah, and I mean, yes, there was, you, as you say, you've moved from voice trading to electronic trading. So, and often these stocks will have circuit breakers in them. So you can't, if it moves more than 10%, or even actually, I think, I'm trying to remember in Italy, I think that you could see at the beginning of the day, there are two upper and lower bounds, which may be 5%. So that if it moved a certain amount within the day, or even I think within a certain number of ticks, it would just get halted for 5 minutes. So you've got this nightmare where actually, for instance, you as a market maker, I'm not talking, I mean, we back then I was just trading purely agency, so we weren't taking on risk. But you might get, slotted in a line of stock, and then you're trying to trade out of it, and the stock keeps going limit down, so you're literally stuck. And it can get that horrible thing where you get to the end of the day, you've still got it because it's been suspended for the whole of the day, and you're stuck wearing the position, thinking, I'm pleased. I hope this thing at least opens tomorrow, so I can actually get out of it. I mean, it's
unhedgeable too, because there's such idiosyncratic risk.
Yes, you can't sort of sell a basket of other, supermarkets, whatever it would be, against it. It is purely that name alone.
I mean, it's just amazing. Well, I think as I read, the equity was cancelled in the restructuring, and these were ordinary Italian savers that were that wiped out, that had bought into this business because they had it on the dinner table or the breakfast table. They knew it.
Well, think. I mean, I'm sure. I mean, you said it was listed back in 1990. I'm sure way back then it probably paid a dividend. It was probably a sort of a safe Tesco-ish type holding you would have, and then it starts to do some quite fancy financial engineering, and the stock, I assume, would start to motor. So it's a sort of, not that it's a meme stock or anything, but it's probably been quite a key holding for sort of people, and kind of it would be held out as the sort of a great sign of Italian ingenuity and stock market, great performing companies, etc.
Yeah.
So as is the way, it's the retail people that end up getting burned by this stuff. If this stuff is cancelled and it just goes out at zero. I mean, I think it was bought, I think, in the end, wasn't it? I don't know if it was bought out of restructuring or how.
Yeah, it would. Yeah, we'll talk a bit about that, I think, in a sec. But yeah, and as you say, sorry, ultimately, yeah, it was taken out in 2011, and I think probably, because that restructuring was complicated, and I think you've made the point about the little guy getting carried out. That there was an equity stake sold in 2011, but it was private equity, and I think actually, if we can get hold of Ricardo, I think we should do a follow-up episode.
Yeah, no,
because I think he will have traded that, and that's a story in itself. But
I'm sure
we're great. I'm looking at the time. We're already kind of well into this one, so I think we'll leave the restructuring for another time. But there's enough lessons learned, I think, in the story up to the collapse in 2003. So the equity guys were wiped out. In insolvency, they sit at the bottom, and yes, there was litigation that followed, but really they're in the waterfall structure. They're not in a good position at all. The bondholders, well, there were straight bonds, there were structured notes, there were convertibles, as we've talked about, there was offshore debt. The defaults, triggered all kinds of cross-default clauses, and the litigation that followed, because bondholder disputes, that's wonderful fodder for litigators. That spanned jurisdiction, so there was some recovery. Because there were some assets around, but the losses were deep for bondholders. And, we mentioned that there was this convertible bond deal. The fact that it came so close to the death in 2002, that really was quite controversial when people look back with hindsight at it, because it raised real cash for the company. 500 million. Major banks involved in that syndicate, but in particular Credit Suisse First Boston, as they were known back then. And the later litigation, because it was that subsidiary that had the cash that the convertible bond was issued against. There was this sort of networks of kind of Brazilian and Eurobond deals that were all interconnected. And you had, the court filings talking about, large subscription agreements, side agreements, risk transfer clauses, receivables that had been presented to bondholders and potential investors, later disputed. And so it really was, a difficult situation. And you have, someone like Credit Suisse First Boston, with hindsight, you'd think, gosh, they should have known better. Where was the due diligence? And, I went through, so many convertible bond issues where you are the lead manager and you go and you have your, your equity capital commitment committee, or whatever you want to call it, new issue committee, where you're laying out the trade before you're going to actually sign and say, we're going to do this trade, but you want to get the internal approval. And everyone's there on that committee. You've got the compliance people asking, whether we've, done due diligence on the customer. Have we adopted the customer? You've got people from market risk talking about what the exposure is. If this transaction doesn't go, are we going to take it onto the balance sheet? What are we going to do? You have people from banking coming in telling you, what are the related other potential issues around, without necessarily dragging you across walls, but telling you what they can about future deals and so on. The salespeople talking about who, what customers are interested, what kind of book is being built, if there are any kind of anchor orders, that kind of stuff. And I think in the case of Credit Suisse First Boston, what one, you think, well, yes, you should be doing the due diligence. But another thing too about, and just not just about them, but just investors in a convertible bond issue. A lot of convertible bond issues come on an accelerated book build basis. So market closes, you then launch a term sheet out to potential investors. And within a couple of hours, they've made a decision and allocations are being worked over. And there just isn't time for you to really go back and do a deep dive into, the financials of the company. An issue like this, you would be putting a lot of reliance on the fact that it's brought by someone like Credit Suisse First Boston.
Yeah.
You're hoping your lead manager is looking after you. And then the other pressure is, where is this thing starting to trade in the grey market? Because many investors won't even read the term sheet. All they will do is look at where the grey market is trading. And if the bond is coming at par and these bonds in the grey market are trading above par, they'll go, great, that's a great deal, I'm in. Put me in.
Incredible, really. I mean, it's not not part of my world, as I've said, but you could see that something with a 10.5 yield, with technically a backstop of cash sitting in an account, maybe in a slightly different bit of structure or whatever it may be, that looks pretty go deal. You'd be like, yeah, sign me up. And as you say, if you've got the optics of it trading higher in the grey market, it would appear optically sort of a safe trade, So and if you're, I mean, I didn't realise that the window that you might get the call saying, there's a new issue going off, and you've got to make a decision within 2 hours. That's tough to be able to, go and do full due diligence. Obviously, you should have a pretty good feel for what the company does.
Well, you've been a fund manager, and you know how hard it is to kind of outperform others.
Yeah.
And it's terrible to underperform. So if you've got something out there that's delivering value, you kind of have to be in, don't you?
Mm.
It's awful. It's awful. But I think, the review committee, if you were sitting there now, what would you be doing? Well, red flag. This thing is allegedly cash rich with this big bank balance at Bank of America. Why aren't you using it?
Yeah.
So, the fact that it's constantly issuing debt, that's a real worry, particularly, it's not like they were issuing debt at 1.5%. They're paying 10.5% coupons, and they've got a load of money in the bank. I mean, how much were they earning on that in the Bank of America? They weren't earning 11%, were they?
Yeah.
So it's, again, the purpose of the funds. Is this real funding, or is it just optics? What's happening here? And again, within the group, who's really bearing the risk of issuing this paper, and what is it backed by? Could investors be being misled by the disclosures that are being made or not being made. And again, for the issuer, for the market, for the lead manager, will this look defensible publicly? Where does this look a stand in terms of reputational risk? So, yeah, complexity definitely a risk indicator. And banks, they can't wash their hands of this. The lead manager has real skin in the game because of this, reliance people place. Particularly when something's got a book build of 2 hours. So, I think that's something for the auditors to think about. If you're looking at, origination, ask yourself the question: if the business is presenting to you that it's all in the hands of the investor and so on, yeah, possibly from a legal perspective, yes. But I think there is a lot of skin in the game for the lead manager and a lot of assumptions that people will make. And that's where I think, you really can get value in terms of probing as auditors to protect the business and really open their eyes to that kind of stuff. Now, of course, where you have any business like this going under and bondholders are out of pocket, then you get the asset recovery, the asset tracing, that has to follow from this. This would have been a dream for those kind of asset tracing investigators. You've got hundreds of entities. You had offshore flows. You had circular transactions. Where you're going for your freezing orders. You're looking at cross-border stuff. So you need cross-border cooperation. That really brings about legal questions about, where are you going to apply for your freezing order? Is it here? Is it offshore, etc.? Forensic accounting, court orders, the real sort of freezing strategy really comes into play. Mm-hmm. But, the hard truth, I think, for people pursuing Parmalat, because it was literally weeks that they worked out that the debts of Parmalat was something like 14 billion.
Yeah.
And they just didn't know that exists. And at the end of the day, you can't recover money that hadn't actually existed. So people, tried to pursue it aggressively on the recovery basis, but very, very difficult to recover stuff. And what did this throw up as a result? Because this clearly was a massive failure in governance at Parmalat. So, there was a kind of a stronger audit skepticism. I have read, which I think is wonderful, there's a greater focus on confirmations and their provenance. But think about that nowadays, it's all very well laughing about Leeson and these guys with a bit of a fax machine and Xerox to confirm. But in AI now, really trying to work out the provenance of information, I think, is going to get very, very hard for people, and that's something that's got to be thought about.
Yeah, and I know we're wrapping up towards the end of this, but it's why would we look this far back to see stuff? But we saw this again in Wirecard not that long ago. There was a lot of credence put on an alleged, I think it was nearly 2 billion euros that sat out in, I think it was the Philippines, and that they'd sort of checked the account and they'd been told it was there, but actually when they really had a look, both banks said, we've never heard of this account. What are you talking about? You sort of assume that technology, etc., would make all this stuff, you roll your eyes and go, surely that wouldn't happen now. But it still does. And I suppose, like some of the other podcasts we've done recently, it is, you sort of go, how can a trader do this in this day and age? But they just happen again and again and again. And this whole circular financing, I don't want to cast any aspersions on stuff that's going on now in private equity, private credit. But we saw Tricolor, we saw First Brands quite recently. These were companies that had very opaque, complex structures that looked like a sort of tube map on the wall when you look at who's linked to where, etc. Companies are still playing this sort of game, and it's I think auditors and everyone within compliance and control functions need to really be asking some quite difficult questions about why is this company still raising money? Surely something's not matching up, and maybe it's just a smell test, which is if they've got this big account. Well, one, we should really go and check it. But if not, why is it having to come to the market constantly to raise money? You know, it's and it still goes on.
Well, it does, and I think you've talked about some of the control functions, but market risk managers as well. I mean, every time I turn on Instagram now, and I'm not being bombarded with some Pam Bondi being on a deposition or whatever, avoiding a deposition, controversial. Then I'm hearing about AI companies and how there is circular financing going on there, but there's a big claim that's going on that people are one is invested in this and they're invested in them, and things are getting passed around, and that's a big worry. And I think if you're looking at the exposures that your desks are running inside of firms, whether it's in particular businesses or relationships that relate to issuance and origination, it's something that really people have to think about and be alive to, because it does feel like there's banana skins out there. And Wirecard, I mean, what a great example. Who would have thought this sort of stuff could happen again? And yet Wirecard was so high profile. I think people have done Wirecard to death, Damian, but maybe in 5 years' time, the Skadi podcast will go back and have a look at Wirecard, when people have forgotten what's happened. But anyway, what happened ultimately to Parmalat, I guess, is the good news in terms of the employees, because milk was still sold, factories still ran. It went into restructuring, it carried on, and in 2011, it was acquired by the French group Lactalis. So, ultimately, all of that fraudulent activity didn't mean it was a broken business.
Yeah.
At the basic end, it was okay. So I guess, anyway, the final takeaways from the Skadi podcast and this wonderful episode, which I've really enjoyed, DT, because, I love a fake bank account.
Yeah.
Complexity is a signal. Repeated financing, that's got to be a red flag. It has to be a scrutiny. Why is that? Obviously, the confirmations process, which had to be scrutinized after this. Again, late stage financing at high rates, which was what that convertible bond was. That's got to be questionable, and you need to be skeptical around why a company that's got so much cash was prepared to pay so much for financing. And sometimes there are good reasons for that. I've done some pretty goey trades, but I had comfort. I knew why that was happening. And if your traders don't know why, or your originators don't know why, that's not good. Auditors, ask them that question. So narratives definitely have to be challenged and interrogated. So there we go. Parmalat. Great story. I've got some wonderful artwork to put out to accompany the episode, or to advertise the episode. And that was, I got in touch actually with a guy in Germany, because I found some free to use stuff. Lucas Reich, I found him on LinkedIn. I sent him a message, said, hey, seen these great photos, Formula One cars, Parmalat, are these yours? He replied back, said, well, I love Formula One, but they're not my photos. But anyway, shout out to him. So I hope he enjoys the episode, because he's a new follower of the Skadi podcast. All right, David, till next time. Thanks a lot, mate.
Yeah, cheers. Well done.
All right, bye.